We're now on to learning objective 3, and we're going to talk about detailed corporate income statements. Now there's some parts in here that we're going to skip over from the text, but yeah, let's have a look and see what we've got going on here. So corporate income statements, we're always going to produce something in the bottom line called net income. And it probably is the most important piece of information about the company. If a company is successful and it's making profit, then it's probably going to do okay. If it's not making money, if the net income is relatively low or maybe a loss, well, there's a chance that we won't be able to keep up and we'll end up shutting down. So net income is probably the biggest thing that we need to know, and that comes off the income statement. It's those earnings. It's those earnings and profit that you make over time that allows you to build up assets and shareholders' equity and to get bigger and bigger. And it's those earnings that attract new investors to invest in your company. Now, here's an example of one where we've got the normal sort of stuff going on at the beginning here. If we look at this, we've got sales revenue, we've got cost of goods sold, and we've got gross margin. So that's a pretty normal resale company. We've got some operating expenses, and we've got sort of operating income, which would be the difference between those two. And then we get into some related sort of numbers on the income statement. Loss on restructuring operations. So if we've got some sort of costs because we've had to restructure some of our debt or some of our equity, well, that's fine. We pull that out because it's not part of normal day-to-day operations. So we pull it out. Same thing for a gain or loss on the sale of any sort of property, plant, and equipment. So in this case, it's a gain of $42,000. The net of those two is added in, and so the income from continuing operations is $180,000. And the tax that would be generated, so this is corporate income tax, because we can tell it's a company because it's got Inc. in the name. The income tax expense is $63,000 in this case. So moving ahead then, our income from continuing operations would be $117,000 after tax. Now this is the stuff we're going to miss. Discontinued operations, we're not going to examine that in this particular course. That's probably a little beyond the expectations here. Just know that what it's about is where if we took a division and we decided to shut it down, well, we've got to pull those operations out of the numbers, the regular operating numbers, just so we're comparing apples to apples when we move ahead. So in this case, yeah, the discontinued operations made some money, but we're not doing it anymore, so we pull it out. So in this, or in this case, we had the profit in from those things. In that case, then our net income is $162,500. Now we get down here to something called earnings per share. So, and this is earnings per common share specifically. So, and that's normally what we're trying to calculate. So if there's 60,000 shares outstanding, then we calculate the income from continuing operations and the income from discontinued operations. The 117,000 divided by 60,000 shares will give you $1.95 per share. And then you can see that discontinued operations is just the 45.5 divided by 60,000. Total net income 271, which would be 162,500 divided by 60,000 shares. So what it tells us is per share how much profit we made, and that's something we can compare amongst other companies. Now, continuing operations help users make predictions about the business's future. So again, it tells us that continuing operations we expect to see in the future, we expect it to happen the next year and the next year. Well, it gives us something to measure that against. So you can see sometimes the $20,000 loss on restructuring operations, you're not going to have that again. Hopefully, you're not going to have those gains and losses, but you are going to have things like income tax. The idea is to understand how those all fit into a corporate income statement. And earnings per share is the amount of the company's net income per outstanding common share. In this formula that we've got net income minus preferred share dividends over the weighted average number of common shares. So in essence, how much are we making per share of common shares? That's an important measure of the profitability of a company or how successful they are. In this case, we're going to go through the weighted average number of common shares, and so we can see how that number is determined. So let's take an example to work our way through this. So this is IMC Communications Corporation. Excuse me. From January to May, it had 240,000 shares issued. From June to August, it had 200,000 shares issued. And then from September to December, it had 210,000 shares. So it looks like it repurchased 40,000 of its shares at the end of May or at the beginning of June. And then here in beginning of September, we issued another 10,000 shares. So what we try and do is to figure out over the year, based on the number of months, we figure out the weighted average number of shares that we had outstanding as part of the earnings per share calculation. So let's take a shot at this. So the number of common shares, we know in the first period, which is January through May, we had 240,000 shares outstanding, and that was for 5 of 12 months. So the weighted average number of common shares for that 5-month period is 100,000. And then we've got 200,000 shares outstanding for, excuse me, June through August, 3 of 12 months, in other words. So again, the multiplication, 200 times 3 of 12, 50,000. Then for the balance of the year, so September through December, which is 4 months, we had 210,000 common shares outstanding for 4 months. Do the multiplication, you'll end up with 70,000 shares. So the weighted average number of common shares in 2020 is 220,000 shares. And the earnings per share is just the net income divided by that number. So now let's take this a little bit further. Let's have a look at the same information, but assume there's a 10% stock dividend that was effective September 1. So let's work out the weighted average number of common shares outstanding. So let's have a look here through the different calculations here if we've got this stock dividend. So if we had 240,000 shares outstanding, then we have to add in a column for the effect of the stock dividend. So it was a 10% stock dividend. So we would multiply times 1.1 to get the increased number of stocks. And then we go through the same calculation. 5 months of 12 will give us weighted average 110,000 shares. Then during the period June through August, 200,000 common shares issued. Again, times a 10% stock dividend to get the right impact, times 3 months. And then the third number here, we know that 231,000 actually reflects the 10% stock dividend already. It's 10% of 210,000 shares. So it's 231 times, there's no impact because we've already got the additional shares in there, times 4 of 12. So that gives us 77,000. So you can see how our weighted average goes up as a result of that stock dividend. We end up with 242,000 in our calculation. So now, again, if we use the same information and we assume a 2-for-1 stock split effective September 1, okay, then how does that impact us? Let's have a look and see. So again, we have 240,000 shares in January through May, and the effect of the stock split is to basically double the number of shares. So we end up with 200,000 shares there as the weighted average. Just doing the math, 240 times 2 times 5/12 for 5 months. The second part here, again, we just calculate 200,000 times, again, the effect of the stock split, 2 times 3 months of 12, 100,000. And then this number will include the stock split. So in other words, we had 210 shares, we double them, so we end up with 420. We've already got the effect of the stock split in this number right here, times 4 months, 140. So the average number of shares outstanding for the year, 440,000. Now, when you're doing your earnings per share calculation, you also need to make sure that you deduct any preferred dividends that you are going to pay or need to pay from net income before you finish calculating earnings per share. So if the dividends are cumulative, then the annual dividend is deducted even if it's not declared. In other words, you're going to have to pay it sooner or later, so keep it in the formula. If it's a non-cumulative preferred dividend, then you don't have to. It's all based on whether you did pay it or not. If you did pay it, well, of course, you're going to deduct it. If you didn't pay it and it's non-cumulative, okay, then you don't need to record it. So let's have a look at that. Earnings per share is presented both basic and diluted. And just understanding those two concepts is critical here. Basic means whatever the outstanding common shares are, that's the denominator in the calculation. Diluted just means if everybody who had some sort of option or right to actually convert some sort of investment into a common share, then how many would we have if we had fully diluted those earnings per share? And in other words, if we had all those common shares outstanding, even though they hadn't been issued. Well, that's something, called diluted earnings per share. It's always going to be lower than basic earnings per share. And you're going to catch that actually in the next course. We already talked about this one. Let's have another look here. Yeah, so we're on to price earnings ratio. This is an interesting number because these numbers nowadays in the stock market are getting a little bit crazy, but let's see what we can do. Price earnings ratio is the market value of the shares divided by the earnings per share. It gets used a lot, but basically it says, how long does it take for me to get my money back based on how much they're earning per share? So let's just say that number can take a long time for people to earn their money back based on net income.